Welcome back to another episode of the Backholder Pod. So I think we want to have a warm welcome back to Eric. He has recovered and he's back with the team. So I think based on, or at least to continue on the conversation from last week, we actually had a discussion around many of the dividend stocks and specifically banks. So how can we not have Eric on to talk about Singapore banks? Because right now, he has the biggest position and biggest vested interest in many of these banks. So I'll pass the time over to Eric to maybe share some of his thoughts around DBS or some of the other banks and their latest earnings quarter.
Okay, so did a short write-up for today lah. So you can see that DBS, right? Because why I want to show DBS instead of all the other banks? Because I hold DBS. I don't hold the other banks. So I'm more interested naturally for DBS. So I did this write-up mainly for DBS. But if you want to ask about other banks, I probably have some vague idea, but I'm not into the very deep financials. So the main segments for DBS, there's four. Consumer banking, which is the one that front-facing lah. We are the consumers, right? Wealth management for rich people like Kelvin. Then institutional banking, like for the other institution and all their trading, investment and all that, treasury market. This one I'm not very sure what is it. Maybe Boon Tee later you can expound a little bit. Market making and all that, I'm not very familiar with it. Then others is like others. Everything else is not listed here. So these are the four main segments. So when you look at the Q2 overview, right, the results, the net profit is 2.6 billion in one quarter. So year on year is up 45%. Quarter on quarter, 5%. I think that's decent growth for banks because they are supposedly quite matured businesses. So if you look at the first half, right, I only had the data for first half. I think the consumer banking wealth management segment is about 35%. The institutional banking is close to 60%. So together, right, those two are like the lion's share of their income, if I didn't calculate it wrongly. So these two are the most important. Return on equity, it was about 19.2%, which I think one of the analysts asked Gupta, right? Like, wow, very good, the ROE so high. Then you confident can always 19% or not? He's like, of course not lah. 19% is like a once-off thing because of the interest rate and all that. So he's more confident in the 15 to 17% range. That's what he said lah. So this I plucked it from his presentation. I think it was the AGM or something. Yeah, so this was for last year. They are ranked 8 for the top 100 banks in the world. So in terms of the return on equity, they are up there. That's why they have a premium. Later on, we can look at the price to book ratio. This one is the net interest margin, 2.16. I think this compares quite favorably with the other two banks as well, which I think they have some slight decline or something like that. Yeah. So he also mentioned that 23% of their commercial book is going to reprice, meaning that they have to renew their loan. So basically, he said about 2% upside. Okay, so that is probably a tailwind for them. Loans like mortgage and all that dropped 2.1%. You say it was due to loans shifting from Hong Kong back to China because renminbi is depreciating. So it's mentioned that if you're a borrower, right, you'll want to borrow in a currency that's depreciating. Yeah. Cost to income, this measures the bank efficiency, is the lowest compared to the other two banks, which is why they are priced at a premium. Expenses up 3%, quarter on quarter, 16% year on year. Nothing much to say there. Non-performing loans, I think they remain the same since Q1, which is, I think the lowest are tied with OCBC. Yeah, non-performing loans. So these are, I think, the loans that most likely they are not going to get it back or something. This common equity tier 1 is basically the buffer they need to have to conduct their business, if I'm not wrong. So the requirement from MAS, 9.2, they have 14.1. this is after the recent, they were slapped with some penalty because of the digital disruption earlier in the year. So their PB is like the highest 1.57. If you look at the other two banks, 1.02 is close to 1:1. OCBC is 1.15. Dividend yield is currently standing at about 5.6. Okay, about 5.6. So Gupta say that there's an upside of $1.20 on top of the 24-cent per annum increase that they project every year. So they have this buffer, $1.20 that they can play around with. So they can either give it as a special dividend or they spread it out as a normal dividend. Yeah, so this is like their additional cash. Commercial book wise, this one I am not very, very sure how it works, but I'm just plucking out all these numbers. Net interest income is about 6% up. If those of you that are into this, you all can read off the numbers because I'm not sure how this thing works anyway. Okay, loans dropped 1%. CASA is the current account, savings account. So there was this analyst, right, on the conference call. He was asking like, hey, how come your CASA drop? Like, wow, people not depositing with you, is it? Then I think the Gupta replied like, this one don't need to worry. Our deposit is the biggest. So we are not fighting on that front anyway. Yeah, I think he's referring to the bulk of his income doesn't come from this CASA. It's more from those like institutional banking, wealth management, those things. Yeah, so commercial book, you all can read. Basically, one negates the other. Then digital bank impact, right? Like the C and the, which is the other one? GXS, is it? Something like that. Or the digital bank. He was saying that when he looked at UK and Hong Kong, right, which have all these digital bank, they don't take a lot of market share from the traditional banks. And it also takes a long time to impact the system, the banking system. So he don't see a cause for worry. I think also because the digitalization for DBS is going quite well. Yeah, getting a lot of profit. Then this India bank thing, I don't know whether you guys remember. Was it last year or something? They have this bank that was like failing. So they need someone to take over. And somehow they got to ask DBS. And then I remember there was a lot of netizen like on the forums, they were dissing this move, like, wow, this Gupta anyhow buy, and then it's gonna burn a hole in DBS and blah blah blah. Yeah, and then now this analyst asked like, hey, so what's the cost to income ratio? Like basically how much it costs to maintain the bank operate and how much income you get from there. So he said it was close to 100% when he bought it. Then the CEO said that they have stopped tracking it separately, but it's profitable by itself. Okay, so that was the update for the India bank, which I think is quite a good job. They managed to turn it around like relatively quickly. Yeah, so that's the update. In case you all want to see this document, I think I will just put it under the comment section.
But maybe I also do a quick screen sharing to give some context.
Everyone is screen sharing today.
Okay, so actually this one is coming from the 2022 annual reports. So the numbers itself is a bit dated already, since we already have 2 quarters of results that's not reflected here. But I still think that this is a good picture to try to understand like what are their business model, because I think there are many people who investing in banks, but yet they don't know how bank makes money. So I think here, right, you remember last week we talked about like whether DBS is innovative or not, and is it important for banks to be innovative or not. So I try to illustrate it using the tables that's provided here. So as you can see here, this is their, you can call it like their P&L. I'm not sure whether that's a good word, but basically it shows how much income they earn, total income here, and then how much is the total expenses, and then you have the profit before tax numbers here. So the top part here is 2022 number, bottom part is 2021 numbers. And there's a lot of commentary on why the figures move throughout that 1 year on the left-hand side here. Okay, so I just want to bring attention to these numbers here. As you can see, there's a net interest income, right? This is actually the one that I said their core business. They lend money out to businesses, they lend money out for people to buy homes. They actually take a spread, right? The spread meaning that how much interest that they charge to the borrowers versus their funding costs. And their funding costs could be, they just borrow money from the interbank, or which is the better one, is they take the monies that people deposit into the banks and lend out, because the cost on that is even lower, right? So they earn a much larger spread there. So you see here, net interest income, right? 4270, or maybe we can just look at the total here, right? This number, 10. This is in millions, so this is 10.9 billion. But 1 year before that is actually 8.4. So you see a huge increase from 2021 to 2022. But this is the core business, right? But if you look at the other parts, right, which is the business that is not related to, like lending. These are, they're selling wealth management products, doing, like their brokerage business. All those, right, is not lending business, but those will fall under these two here. Okay, as you can see, there are some numbers that not all of them actually increase. For example, this one, net fee and commission income for the consumer banking of wealth management, it dropped from 2.2 billions to about 1.8 billions. So I do see that, let's say if there's more disruptions coming from other, for example, all these fintech, they do saving, they do products, meaning people don't buy so much wealth management product from the banks, right? So it will affect the numbers here. These are the numbers that may be affected. In terms of the relative size, right? Of course, the lending business is still the main core business, but all these commissions, wealth management products, actually they are having very high profit margin. That's why if this part is taken by the fintech, right, it will affect their profitability quite a fair bit. So I think that's quite important to note now. Yeah, I think here there's further breakdown showing their non-interest income, and then you can see the details. For example, like credit cards, wealth management products. These are actually the areas or business where they actually earn quite a lot, because as you know, for those who borrow or use the credit card to fund their spending, and if you can't pay off your credit cards, right, the interest rate is very, very high. So all those are actually a good profit margin for the banks. And if they are not able to attract people to using their cards, right? Because maybe others go and use other cards, right? For example, like a trust bank account and so on, all this fintech coming in, right? So all this may be affected. I think that's my point when we talk about the disruption from the digital products or digital banks.
I think in terms of the specifics of the commissions of many of these wealth management products, right? If I'm not wrong, I read it somewhere, was it from Gupta or some of the other CEOs? They did say that it is a short-term headwind because of high fixed deposit rates. So actually a lot of the wealth management products, essentially, whether you sell life insurance or whether you sell endowment plans, these are in direct competition of your T-bills, your whatever, because they all have a goal that they want to save to, whether it's kids' education or whatnot. So I think when rates start to come down, assuming that they do come down and your fixed D and all the much safer instruments like your bonds come down, I do think that there would be some sort of revival in terms of these commission and take rates, because at the end of the day, for now, it's cannibalizing on those numbers, but I don't think it's a long-term structural headwind unless we are expecting for interest to remain elevated for a very high period of time. I think there's just some context on why there is this year-on-year drop by such a large extent also. I think it's more than 15%. I did a rough calculation, it's like 10-15% year-on-year drop. So I think that's not really a very long-term thing. And it's also not like the sales force sucks or like the wealth managers are lousy in doing, like they're doing a bit worse job compared to last year. I think that's just some context.
But I think I'm a bit skeptical on this. I know whenever there's one business line drop, usually management will give some excuse, right, or give some explanation. I'm a bit skeptical on whether those are the true reasons. Because, for example, right, if you say now people don't trade as much because interest rate is high, so they rather use the money and pay off their mortgage, whatever it is, right? Then it's fine. But my worry, right, if I'm investing in banks, right, is that what if the monies actually like in terms of the revenue, it dropped not because of this reason, but because people move on to the new generations of brokerage app, which is more interactive, or some other fintech solutions that provide a much better UI as compared to the one that banks are able to provide, or like you say, insurance products, right? Last time, people don't have that many choices when it comes to investing, so they have to go to like buy ILPs to access to diversified funds. Now you can go direct, and there's so many funds and that offer good UI, right? So I think there could be some disruption coming, but it's not like coming in a big way, but like small steps like keep eating up the market shares. I think that's more like a long-term concern.
To further extend the point, because I think you're getting somewhere, but I think to also like make the discussion richer, right? I think we are especially for us investors or people that are, we treat this as a hobby. We spend hours per week to come and talk about investing, about many company analysis, right? But we have to kind of keep in mind that actually a large swath of the population, they are just not interested. And a lot of these kind of insurance investments, they are sold, they are not bought. They are bought in our context because a lot of us are already privy of financial literacy and stuff. But I think still a lot of funds are being locked up in your normal CASA accounts and whatnot. And you need this, for the lack of better word, salespeople or intermediaries to convince people to convert their savings into investments or savings into this kind of insurance products, endowment products or whatnot. So I think just some context, I do feel like, because at least from how I understand the industry, they are always benchmarked, or a lot of all these insurance products are benchmarked against, like you need to have some sort of feel of, what's the current interest rate like, or are there any better alternatives? And whenever you try to do that benchmark, a lot of the insurance products, when you compare the last 10 years, 20 years return, definitely lose the current 4% or 3.5% that they offer. So that's why I think there is some sort of challenge to sell in this particular instance. But I remain open. I mean, my mind is not set that this is really the reason. I think we can take the following. It's a long process. You need to probably wait for 2-3 years to see whether this is really the reason or not, or whether it's really being disrupted by fintech. But I think the fintech, that's it. From what I understand, or from my friends or people that are younger, a lot of people are just jumping on the interest rate rather than currently there's a lot of money market funds and people investing, right? There is still a very, I don't know, I guess it's a deterrence that people need to do something with their money rather than I just put my money there and then you give me the interest rate. I still need to have an additional step to put the money into the funds, even though they're young, so-called young people. I still don't really see it very done actively, unless you're in the finance space or you really take charge of your financial future and you want to invest. Unless those very garang people, if not the rest of the population, I think they're still in the very nice bubble and they need people to come in to tell them what to do or what not to do. I guess that I'll just lay my case here. Anyone else and want to further the discussion here?
I think to address Boon Tee's point about that the fintech thing, right? The thing about DBS is that they put themselves as a startup. They think of themselves as a startup, not as a bank. So I turn to share screen.
Oh, while Kelvin is sharing, I think I suddenly had a thought just now about the CASA account that Eric was talking about, right? For that specifically, I think DBS don't need to scare, not only because they have a high deposit base, but because a lot of the users are disloyal. So if DBS just wants to signal more money back to get back those very cheap funding from the people, right? They just what's their account? I've forgotten already. But yeah, they can just jack up the interest rate and then everybody just flow back again.
But that's the thing, it will affect their margin.
In terms of to kind of attract. Then they will layer in a lot of conditions, right? And then they'll make sure that you can't really hit the so-called promoted rates, but that's another topic.
Yeah, because what Eric just shared, right? Actually, right now they don't have to do a lot on the deposit side because I think they still have more money than what they need to lend out. So they are not that bullish in terms of the lending and like keeps pushing money out. So they have a lot of money. That's why there's this news that say they actually have to buy some government bonds or something. Then because they have excess of deposits, right? So that's why they are not in rush to go and attract more deposit. But let's say if this trend continue and more other banks jack up their interest rate to make it more attractive, right? Then the deposits from DBS will flow out, right? Then they have to adjust and compete for the so-called the cheap capital or the deposits.
And ironically, it wouldn't be cheap already if everybody starts competing up. So it's a cycle. But yeah, okay, back to Kelvin.
So for that high yield bank accounting, DBS didn't really compete. I think 1 or 2 weeks ago, they actually changed their interest rate a bit to make it less conditions. But still, they didn't try to compete. So that just shows, it's like the Tesla thing, right? Tesla thing, they say, we have a lot of levers to push to attract demand. And DBS haven't even done the pushing part yet. And it's already 1 year later after the UOB, OCBC have jacked up their interest rate. DBS has actually done nothing much to compete on that front. So just like I mentioned that DBS, they think of themselves as a startup is because they keep trying to add in new technologies. So this is their report that the Boon Tee has shown just now. This is their logo. This is their slogan. More like a startup, less like a bank. So what they did in the past, they launched the first world largest banking API platform. So this allows all the developers to work with them. The one that I reviewed earlier a few weeks ago is a Dobin. The Dobin lets you plan your finances. So DBS, the API allows people to do that. Then the next one is actually DBS is already on the AI hype train. So I don't really know what exactly they are doing. Artificial intelligence, machine learning. They have this blockchain thing. Is actually a bit similar to what crypto is trying to solve. They are trying to do this whole global money remittance thing, but DBS is already developing this since last year. Besides that, they also launched this your financial GPS. It's their left planner. They're also the first bank who did this. Then the DBS Digital Exchange, to my knowledge, I think no Singapore bank has done it yet. Well, DBS has already did it. Then this one is also quite interesting. So Boon Tee mentioned about the the brokerage or stuff like Moomoo, all this coming in, right? I think DBS is also not interested to compete on that front because they are competing for other larger markets. Like for example, Singapore, right? The construction industry, I think is quite big. So they let construction companies automate their payments through whatever technology they have. So this is one thing. So they are fighting on other fronts, not necessarily on the brokerage front. It's just a small brokerage. I think for us, small retail investors, the money they can earn from us is actually not that much. If you check like Moomoo, Weibo, not Moomoo, Moomoo and Tigers, their earnings, right, is actually so only as compared to DBS, that kind of earning money they can earn. Just want to add on to Eric's things. His presentation at the start. So if you compare in terms of valuation, DBS is surprisingly quite similar to UOB, OCBC, their price to earnings. But in terms of book price, DBS is more expensive. If you look at this is a dividend yield. No, this is a historical price to earnings ratio. So DBS it looks cheaper compared to 2019. The price to book about the same actually. So DBS right now is like $35, but in terms of valuation, is quite comparable to in the past. But they have a lot more. They are earning a lot more money now. Then this is the dividend yield. Dividend yield right now, just now, Eric mentioned is about 5.6%. And the analysts are expecting this to go up, keep going up. I don't believe this. I believe it will revert back to the mean. Mean is about 3-4%. It's about there. So right now it's on the high side of dividend yield. So if you are planning to buy DBS, do expect the yield to drop very soon, especially next year onwards.
When you say the yield will drop, do you mean that the dividend amount will cut, or is it like the price will go up, so your dividend yield will stay stable?
I think it's both. Price will cut. No, because this year they gave some special dividend thing, right? This latest quarter. I don't think this is sustainable. This is just a one-off thing. After this, I suspect DBS won't be earning as much as this year due to all this interest rate drop thing. So then the next one is this one I found, but it's another discussion altogether. Oh yeah, this is the thing that Boon Tee mentioned just now. DBS has increased their digital share of income from like 49% all the way to 82% in 2022. So I guess that addressed the part of how innovative they are. Then the other part is if you look at the annual report, right, there are a lot of different KPIs to measure their performance. I didn't really look at this part. They also have some attendance record thing to see who attended what thing, to see if people are doing their job or not. If they do this in Malaysia Parliament, I think all the politicians will fail. Some politicians, not all. And I think part of the reason is because their CEO is a bit workaholic. So he said that work-life balance is not real. It's just a perspective kind of thing. Work is actually part of his life. He also admitted that in the past he was very consumed by work. I think right now he's also quite workaholic. So with him as the boss, it's bad for his health, but I think it's good for the company that he likes to work so much. And because of that, when Gupta-san sell off his 3.4 million shares last week, all the netizens were unhappy, right? Wow, he going to sell off 3.4 million. And he tell people that work-life balance is bullshit while he go and enjoy his life. But actually, if you look at this interactive broker, if you look at the insider sales, insider selling, insider trades, there's nothing wrong with DBS. Actually, all the other people have been buying, all the insiders have been buying. It's just that it's only Gupta-san taking his year-end profit to buy whatever he wants. Everything is basically just purchase. Temasek go and sell. Okay, Temasek another thing. But Gupta-san, he sold it. Then if you look at only his insider trades, right? It's only him who has been selling this all his trades. Gupta has been selling every year end, August 8, November 16, 2022, November 23, 2021. Probably he's going somewhere for holiday. He needs all the few $1 million. So there's nothing wrong. He still owns a lot of DBS share. Last week's sale is just 4% of his total DBS share. So that's it.
Maybe I can just add on a little bit. Why Gupta might want to sell some of his shares, because I have a friend, right, who used to be quite senior in a bank. So they will get compensated in shares, right, of the banks. So he has been there for he's retired already, but he's been there for a very, very long time. His whole career, he's been at the bank, senior management. So he got a lot of shares, but he never keep the shares. He just, every time they give him, right, he will just, after the holding period, he will just sell off. So I asked him, why do you sell? Keep I mean, won't the share appreciate? And he said that from a risk point of view, right, it doesn't make sense to have his job and all his shareholdings, right, tied up in one bank. So if the bank goes down, right, he will literally jobless, and then his shares is worth nothing. And he was right, because he rode through the great financial crisis. I mean, he didn't lose his job, but the share price dropped 99%. So he was right to de-risk himself.
The bank start with C, is it? I think it's quite obvious when you say 99%.
Yeah.
Right, C, right?
Yeah, so
Okay.
I think it's from a risk point of view. Even Gupta just selling 4%, you know, is newsworthy. Like, what if he go and sell 100%? Like, but it's also reasonable, right? Because from a risk point of view, it doesn't make sense for him to hold so much DBS.
I'm more interested in what he's doing with the money.
You ask him, huh?
Let's invite him.
Thanks, Chiking.
Yeah, I just have one question because just now we talked about like all these startup, fintech, the stuff that all the initiative that they have been doing, right? I guess all of us here have DBS account or you using their credit card or I mean their customers are in some products or others, right? Have you really feel that you are delighted or surprised by anything offered by the banks, any services or any products? Have you have this kind of experience?
You mean the stuff that I like about DBS?
Yeah, and any service that any new initiative that they came out or anything like wow, you say wow, this one's so impressive. DBS done that. Wow, you make you delighted. Is there any such experience?
The DBS, the NAV planner, but yeah, it's the part that they let you do your financial planning because your money is with them, so they can already help you plan for your finances, your retirement, stuff like that. But that part, every other bank has done it since then already. So that part is already like lost its mode lah. I think the bigger part is actually not experienced by us. Is because we are just retail ma. It's more about the other collaborations with other big companies that we can't see.
My biggest delight is the $3 hawker every Friday that they give PayLah rebate. That's how they contribute back, right?
Yeah.
I mean, no lah, but I think on a more serious note, there is this new initiative, not particularly for DBS Bank. I'm not too sure whether you guys know. It's called SG Findex. It's essentially a consolidated platform where they participate with all the financial institutions, FI, not only banks. So they participate with NTUC, Prudential, whoever. Then they basically allow you to consolidate your financial overview in one platform. And then you can see what insurance coverage you have, what wealth products you have, how much money you have. I'm not too sure whether CPF can see or not, but it's basically a one-stop platform for you to manage your financial future. I think it's quite underrated in a way where people don't really see benefits. But I think for those of you who track like Excel, right, it's very, very tedious and very, very challenging on your front. So it's a national initiative. Just want to give a shout out to the government that also give them credit that they created something like that. I think there's still a lot of improvement to be done, but then it's a chicken and egg problem. If people don't go onto the platform, they can't get feedback. They can't get feedback. They can't improve. Then the platform continues sucking, and then people will say that the platform sucks. So I just wanted to say that for those of you who are interested, remotely interested in tracking this kind of things, can go and sign up and link all your bank accounts together. But that's not necessarily a mode for DBS. It's just a side thing. But yeah, back to Eric.
Actually, that's the DBS NAV planner that I mentioned just now. But yeah, Chiking, thanks for elaborating for that.
But Findex is a national thing, right?
Yeah,
like it's a government.
It's a back end thing. DBS is building on top of the SG Findex. But then when the Dobbin, actually that part is the competition is heating up. So what DBS and all the other banks, the part that they can't do is recommending certain products because they can't be neutral. DBS will always have to recommend DBS products like DBS insurance, DBS credit cards. Then this Dobbin, the stuff that I reviewed not too long ago, they are more neutral so that they can see your finance. I don't think they are built upon the SG Index. They just come up with their own API calling every individual bank. Then they can see how are you spending your money. Then they can recommend specific credit cards that suit your needs. Then in the future, specific insurance that suit your needs, this kind of thing. So they don't have to recommend specific bank. So, but then it's always back to what if the government knows how much money you have? The thing is, the government already knows how much you have, whether you link it or don't link it. It's just don't have to be scared.
I think also one nuance the other time was about DBS insurance, right? So DBS doesn't sell their own insurance. I think they do have long-term partnerships with specifically Manulife and Chubb. So that's like a 10-15 year partnership, if I remember correctly. While on the other hand, I think OCBC is the one that markets. So GE is under OCBC. So they have full control over what kind of products they want to offer, and they know the back end essentially. So there's just a slight difference. So I think the partnership ends in 2030 or 2030 something, DBS and Manulife. So who knows, after 2030 something, they might jump over to HSBC Life or some other insurance products that they start to market again. So there is not really any loyalty. So DBS on this front is a lot more interest based, and who can give them the best offer in a way. But yeah, sorry, Eric.
To respond to Boon Tee's question, right? I think in terms of the payment, I quite like PayLah compared to the other two banks. Like, it feels more intuitive, and there's a lot of people there's a lot more hawkers using it. And then I find it very easy to use, and it's just very seamless. Yeah, it's one of the payment modes that I enjoy using. So, I mean, unconsciously, I just use it quite a fair bit. Yeah, so it's one of the things that have delighted me, so-called.
Yeah. Okay. I asked that question. It's not like to bring on the points that they are not innovative. I also have my own experience, and that one was a wow for me. And I don't usually get this kind of feeling dealing with banks. I mean, with technology products, this is quite often. So the bar is quite high, but for banks, the bar is very low. But specifically for DBS, right? That was when I applied for their credit cards. And then, credit card just sign up. Just actually, when filling in the application is very fast already, because they pull the information from SingPass, right? So it's like within 5 minutes it's done. That part is nothing. But the part that actually impressed me was that suddenly they just give me a message, say, your credit card has been issued. Then I just do a scan on my phone, and the digital credit card is already on my iPhone's Apple wallets. So I was like, so I can use already. So that was a bit like, I know for some of you guys have been using credit card a lot. You know, like this is quite common. Maybe I don't know, but for my own experience, usually it's like once you sign up credit card, you have to wait for, I don't know, maybe at least a couple of days, right? Or 1 week for them to do some check, and then after that they only mail us the card. But this one is like, okay, immediately issued and can use right away. And then of course the physical cards comes later. So that was the first time I was like, wow, okay, now I understand a bit on why people say that DBS, they are digital banks, right? Like quite impressive on this end. Yeah, that's my story.
I just add on to what Boon Tee said, because recently I applied for the UOB One card, right? I was expecting like DBS like that. Wow me, like use the SingPass thing, right? And they say, pull your data from SingPass. And I say, okay, pull it. So they pull, right? Now that I expected like DBS to send me a message like, here's your digital card. After that, they send me a message, right? Really send me a message. Say, your card will be arriving in a few days. Like they will review it first. So I really waited a few business days for them to review and then to approve, even though I had quite a bit of savings at UOB. And then they still check here, check there. Then after a few days, then I received the physical card. They never even bothered to send me the digital card. So it's very different from DBS. DBS is super seamless, like within 5 minutes you get it kind of thing. Yeah. So
then can I ask, why do you still have quite a bit of savings in UOB? Like why are you still loyal as
you know why I'm
customer?
not checking? Because UOB and OCBC, right, are the two local banks that are fighting on the CASA front. DBS is not. Those two banks, they are like, they are doing like 5% EIR, effective interest rate for their savings account. DBS, if you go and calculate, I think it's like maybe less than 4%. Yeah, and then they have a lot of hurdles to jump. So I'm like, what? If you don't jump through a hurdle, I think it's about 2.5%, which is like, what? Why should I put with DBS? But I still put with DBS because they have the most ATM. Their PayLah is the most intuitive, and then all my gyro, everything all go through there. So it's like they are quite entrenched, but their interest rate sucks because they don't see the need to fight for your money. They're like, your money is here lah. You want to go elsewhere, you go lah. So like,
I would also have a complaint that so even for my student loan for what a lot of friends all took DBS because it's intuitive because recognizable brand. But I think one thing they forget is the queuing time, because it's the recognizable brand, is also the longest. So of course I know now you can book online, right? Like to book a queue ticket or whatnot. But sometimes the numbers jump a bit weirdly. So even though they announce that, 10 minutes you can come, then you come already, they say, hey, your queue jump finished already. I don't know what happened, but maybe it's some back end system. But that said, I think when I visit a OCBC branch or a UOB branch, it's a lot faster and a lot lesser people. That's just a practical thing. But most of my money is still DBS because it's the most convenient, most recognized, and especially it's overseas payment, it comes in faster. So I don't know, it just feels safer.
I give you a recommendation now. The faster you can get to private banking, right? You don't need money. There's no queue.
Money. So are you a private banking client now with UOB?
I tell you in private.
Okay, can to ask Eric. So DBS now can buy or not? If I'm interested.
Actually, DBS, right? Just now, Kelvin was saying that he don't see the dividend able to sustain at this yield. I beg to differ a little bit. From now until next year, right, I think they are quite okay until 2024. Beyond that, I don't know lah, because they build up their buffer. They have $3 billion excess, like in reserve. They're not even counting the profits they are making. And he's actually, Gupta said he's quite sure that the majority of their income, right, the one that deals with which one was it? Commercial books or something like that. He said that one is quite stable. There won't be a lot of fluctuation, regardless of the interest rate, how it fluctuates. So they are quite okay with that, earning some sort of a 3% or 5% spread. Yeah, so I think DBS can buy or not. I mean, if you got money, obviously you can buy, right? Anytime you can buy, right? Except when the market is closed, then you cannot buy. But I mean, if you're asking me if I will buy now, right? I personally, due to my risk preference, right, I prefer to have a little bit of buffer. So I prefer to wait until it's somewhere about $30 or slightly below. I would really want that buffer, because if I buy now, right, it's fully priced. It's fully priced for the ROE. So I don't want to like be a hero lah, buy when it's like fully priced. Then when the market corrects, then you'll be like, you're the clown that bought it like when it was fully priced. So wait for a little bit of a pullback or something. Now it's I think 33.24 currently, but about $3 lesser, it will be a nice entry price, I feel.
Like there's nothing much pushing it up next year. I may be wrong. I don't see it, but I don't see any big news pushing DBS up to $40. So chances are it will correct back down to like $30 when the interest rate drops and they start pricing in everything. Yeah. So same with Eric.
I'm not too sure whether you guys have the data of DBS's PB ratio historical. Like what's the range that they usually trade in?
Oh my god, let me find. Wait. This is PE. This is PB. PB is on the high side.
So if you believe in the mean reversion theory,
1.4, 1.5.
I think you can plot some simple SD, 1 SD, 2 SD over the last 10 years. And then you can kind of roughly guess where would be a better entry. I think that's just another way you can look at it.
Yep.
Yeah. If not, any concluding thoughts? Nope. Okay.
You never ask them to smash the like button.
All right. Smash the like button, guys. But anyway, I hope you guys enjoyed the discussion about DBS Bank. I think it's a bank that many Singaporeans hold close dearly to their hearts. We are not here to kind of provide disdain or give you a bad perspective, but really just to shed some light from a consumer perspective, from a financial perspective, and from an investor perspective. So yeah, hope you guys enjoyed the discussion, and we'll see you in the next video. Goodbye.